record here. So just to be clear, we are here on the 13th. We're kind of still going over chapter 8 homework. We finished chapter 9 and we'll start chapter 10 today. A number of people sent me their draft papers. Thank you. I'm still reading them and I will return them to you with comments. The way I usually return them is as a Google Doc with my comments, so you'll have access to the document and you can see my comments and any proposed edits. So look out for an email from my Gmail address inviting you to look at a Google document. I just wanted to remind everybody that from next week, Tuesday, until the following Tuesday, the first test and quiz for the class will open. The first test and quiz, you guys may recall this from when we spoke before, the first test and quiz will be on chapters 8 and 9. The test is for 15% and the quiz is for 3%. There are 2 quizzes at 3% in this class. Before they open, and so it's likely going to be sometime between today and Friday. I'll put up a prep sheet for you so that you can see exactly what will be in for the exercises for the test. The quiz is normally like 10 multiple choice questions. For now, just note that the quiz is not going to be a whole lot of like definitions, like theory. It's going to be actual calculations and things, testing to see if you know how to do some of the major topics in these 2 chapters. You can imagine having gone through these chapters, what some of the big topics would be: FIFO, LIFO, average cost, dollar value, LIFO, the goods in transit for, those types of things for chapter 8. Chapter 9, you've got your lower of cost net realizable value, lower of cost or market, retail inventory method, and gross profit method. So I'm still busy sifting through to see exactly how I'm splitting the points between all the topics. So as soon as I've done that, I'll give you the prep sheet. So what does it mean? Just so we're all clear, what does it mean for this test and quiz to open and to close? All I'm saying is that from Tuesday the 19th, which is next week Tuesday, the test and the quiz will be available on Connect for you to start if you so wish. But remember that these tests and quizzes are timed. So once you start something, you have to finish it in the same sitting. You can't, you can't start something on the 19th of October and then decide that you're going to come back on the 25th to finish it. If I give you 3 hours to do the test, once you click start, the 3-hour clock starts, and you will have to move through the test within those 3 hours. So you can choose any day in the 1-week window when you want to take the quiz and the test. You can take the quiz separately on one day and then carry on studying and take the test on another day. I definitely recommend that you take the quiz first so that you can see how you're doing in terms of your knowledge of the topics. And then after that, after you take the quiz, and you have some idea of what's happening with your knowledge, maybe study a little bit more and then take the test. But again, it has to be, once you sit down to do it, you have to complete it in the same sitting, because the clock will keep going. I can't remember for Connect. I have to ask the McGraw-Hill rep if you can go in and out of the test and the quiz without without being locked out. I can't remember if they told me that, but I will check before the time to give you proper information. So you can finish everything as early as the 19th. It will probably open up around 9 a.m. So you can finish it as early as the 19th or as late as the 26th. But please know that at 6 p.m. on the 26th, that's the deadline. So if you decide to start doing something at 5 p.m., on the 26th, and you don't finish everything successfully in an hour, which honestly, you're not going to be able to finish the whole test in an hour, the system will submit your work, auto submit your work by 6 p.m. And whatever you've done for that 1 hour is that's it. All right. So you should plan to give yourself enough time to finish everything before the deadline. Does anybody have any questions about any of what I just said about the quiz and the test window?
How many items will we have?
Yeah, so I'll give you all of that information. Like I said, between if today's Wednesday, probably by Friday, I'll have a full test prep sheet available that you'll be able to see exactly what I'm going to ask you. It may come sooner than that. I'll send out an email. Normally, I put it on Blackboard. This is the sheet to say these are the exercises that are going to be, the main points on the test. So once I've finished setting the test completely, I will know accurately what it is that you guys need to spend your time on, and then I will tell you, okay? Other questions? All right, so it's at your leisure in your own time. I just want to caution again. I know that you're home or wherever you are and you have access to all the materials, you have access to the textbook and all of that. I accept that, but please don't treat this like a situation where you barely need to study because you have access to the textbook, so you can just page around or look at examples and you'll be able to reproduce things within the time allocated. It's not going to work. All right. You have to study. And I mean, I've had feedback from students in the past in my online classes saying, that they thought that they would. I mean, they kind of like, yes, I did study to some extent, but I thought I'd be able to also just use all the supporting materials and get through this. When you have, and I mean, I'll say this to you guys also, because many of you are going to go on to four-year schools and you'll have some open book tests and things there. I remember when I did my master's at Baruch, we had open book tests for the tax tests and a few other classes. It's actually worse than closed book because the test is still this, you still have the same amount of time, the questions are still hard, but people are wasting time paging through trying to find answers, when really if you have an open book test you should be studying as if you don't have access to the materials, and you should basically just be looking up something if you really can't remember, like maybe you couldn't remember exactly how to calculate if you're doing gross profit method, like which number should be 100% or whatever. Like you're looking up something small just to check, as opposed to, oh, I didn't study this whole thing because I'm just going to copy it over from wherever I did it for homework or whatever. Maybe you can do that a little bit, but the time that's allocated for you for the test is not going to allow you to do that for every question. So just be aware that there is some studying, that's needed to get through this. All right, so that was the I guess the whole thing about the schedule. I'll just mention this. It will come up again before the 15th of October was supposed to be the start of registration for the spring, but for whatever reason, it's now been postponed to the 25th of October. That's the news I've gotten. If you guys, you can still check your CUNY first on the 15th, but if you don't see a registration appointment date, don't panic. I think they pushed it back by 10 days. I suspect they pushed it back because more classes have to be in person, and they're still trying to work through finding space and all kinds of stuff for these classes. So we have a 10-day delay with the registration. Remember, I told you that if you are one of those people who's trying to stay fully online or whatever for the spring, please just make sure that you register early, because there aren't going to be as many online classes available as they used to be. I mean, if you're graduating at the end of the semester, then it kind of doesn't matter. All right. So that's that. So let's get into, hopefully I haven't been kicked out of okay. I haven't been kicked out of McGraw-Hill Connect yet for timing out. So just to set the scene, last time we went through some of the chapter 8 homework. I know that the bulk of you guys finished the homework, and you know, you kind of like, I don't even maybe remember what I did anymore. I do feel compelled to at least review what was asked in the questions, and just go over a little bit some of the concepts. It doesn't mean that I have to go over every number with you, because we all have different numbers. Feel free to log on to Connect on a separate device if you want to see your work. But I mean, we all had the same questions, we just had different dollar amounts, right? So I'm just going to finish out going over this. Just in case there are still lingering questions and so on, because when people start studying now for the, you know, for the test and the quiz, they, you know, things may come up again that you, when you're using the homework to study, and you're like, oh no, we never actually went, you know, over this in class. So let's just do that now. Number 4 for the homework was a perpetual inventory system. Number 3 had been periodic, and we went over that. It was a perpetual inventory system, and it was the FIFO method, and then also average cost. So it's a little bit of a, you know, thinking back to work that we did some time back. But you know, we remember that with periodic, you're doing these calculations of cost of goods sold and ending inventory at the end of the period. And with perpetual, you are doing the calculations as you go along, meaning you're updating your inventory balance as you go along. So if you are, you know, doing calculations for the sales and the purchases as they happen, you can see here in the way this is set up. First, there's a little, you know, section here that just does the calculation of the total cost of goods available for sale. Then you've actually got cost of goods sold, and they're basing it, the way they're doing it is they're saying, okay, there was a sale on August the 14th, there was a sale on August the 25th. I mean, there are different ways to set this up. If we look further down, when we do average cost, they kind of set it up the way we did it in the Excel spreadsheet. So either way is fine. It's just that if you're doing separate calculations, you can do them however you want to. It's just that you also need to be able to plug them into, you know, these little squares. So please just note, especially if you maybe get given a question like this in the test, some of the issues that people have are like mechanical on how to actually work in, you know, to answer the question in the system. So this is the cost of goods sold for August the 14th. This is the cost of goods sold for August the 25th. Then you have the total, and then you have an inventory balance, which is the ending inventory, right? We're saying, you know, which items are in ending inventory. We're pulling all our unit numbers from this column over here. Obviously, all the dollar amounts are here. So what we notice on August the 14th is that we sold 14,400 units. The $13.60 doesn't matter, because we're not trying to calculate sales revenue. But so it's 14,400 units total that we're trying to get at. It's FIFO that we're doing. So the first thing in is the first thing out, which means we must have sold 3,600 of the inventory from the beginning inventory, and then you move on. Yes, 18,000 units, but you only need to get to 14,400. So 10,800 units is what you still need. Notice how the numbers are just the same dollar amounts, right, that are coming from the cost of goods available for sale. So you have your total number of units, and then you have your total cost of goods sold for that August the 14th. Then August the 25th, same idea, you go up and you check, okay, we sold 13,400 units, which means that has to be the total at the bottom over here. You've got 18,000 as what you started with. You already sold 10,800. That must mean that there's still 7,200 left to be sold out of this group, or batch of inventory, and it's going to be at $7.10, the same price. And then to get to 13,400, you only need another 6,200 units. It's coming out of this batch over here, and it's at 660. for whatever reason, the cost of the units is decreasing. So that's an unusual scenario where prices are decreasing instead of increasing. So then you get this total of 92,000. You add these two together, that's your total cost of goods sold. So now when it comes to ending inventory, you already know that you started with 38,000, you sold 14,400, you sold another 13,400, so you're left with 10,200. With FIFO, the latest units are still left behind because the first units are sold. So you know that the 5,600 units must still be there, and that's at 580. And then to get from 5,600 to 10,200, we need another 4,600 units, which is coming from this 10,800, so it's at 660. And so we have an ending inventory of 62,840. Remember, these two numbers together have to add back up to your total cost of goods available for sale. Another hint, and we discussed this in class when we're going through this work, is that the FIFO perpetual and FIFO periodic cost of goods sold and ending inventory numbers are the same, all right? And that's because under FIFO, the ending inventory is the latest units. So it's, whether you do the calculation at the end of the period or during the period, you're still ending up with the latest units as ending inventory. So your ending inventory will be the same under perpetual and periodic, and so will your cost of goods sold. That's not the case for LIFO, and it's certainly not the case for average cost, all right? Again, I hope, this is helpful even as a refresher. If we're thinking, today's Wednesday, the test and quiz are opening on Tuesday. So these things may feel like they were far away, but they're actually becoming more and more relevant to us because the test is coming up, okay? Then, they're just showing another approach to calculating the same cost of goods sold, right? Where you just, you're showing it in a kind of a smaller table. So for average cost, you may recall that, and instead of looking at this, I'm just gonna go down and look here. You may recall that for average cost, the way we're supposed to do it is a moving average, meaning that every time we buy inventory, every time there's a purchase, we have to calculate a new average cost of inventory. And when we sell some of those units, they get sold at the average cost. So you have beginning inventory, it's the same numbers from before. And then on August the 8th, so this is all being driven by this information over here, right? Beginning inventory, then all these purchases. So beginning inventory, that means the average cost of these units is $7.70. On August the 8th, they buy another 18,000 units at $7.10. So you're adding these two together, it comes to a total of 155,520, and divide that by 21,600 to get us to $7.20 per unit. All right. So every time there's a purchase, you have to calculate the new cost per unit. And then we know that we sold 14,400 units. So $7.20 is the average cost. That's your cost of goods sold. And then what's left over is the difference between the number of units that you have and the units that were sold. So there's 7,200 units left over, and they'll be at this average cost now. Okay, because you can't tell out of the 7,200 which of those units were from the beginning inventory or which were from August the 8th. It's impossible to tell. So $7.20 is just the average cost of the ending inventory at this point. Then on August the 18th, there's a purchase of 10,800 units at $660. So there's the total for that. To that, you add this 51,840 of inventory you already have. And that gives you a total of 123,120 as the total cost of the inventory that's available for sale at that point. You divide that by the sum of these two numbers of units, 10,800 and 7,200, that's 18,000 units. So 123,120 divided by 18,000 units, $6.84 per unit is the new average cost. And this number makes sense because remember, I was just remarking that the cost per unit was actually going down in this example. So your average cost per unit is getting lower every time you're buying inventory at a lower price. On August the 25th, you sell 13,400 units. They're being sold at 684. So that's your cost of goods sold. 18,000 units minus the 13,400 that was sold leaves you with 4,600 units at 684. That's their new price now. That's it. You can't split it out and say, you know, which of these units were at 770, which were at 710, which were at 660. It doesn't matter. You just keep the 684. And then the last transaction is on August the 25th, 5,600 units at $5.80, 32,480. So together that gives this 31,000 and this 32,000 together gives you an ending inventory of 63,944. And you've got a cost of goods sold, sorry, of 195,336. So so that's average cost under a perpetual method. And if we look at how this was populated, because remember, like I said, there's, you know, you have to look at the mechanics also of what you're doing. The way you populate it is, it's kind of like this table over here. You're doing the beginning inventory, then you look at the purchase, right? Over here, you can see the purchase. And so it shows you the, you know, the total number of or dollar amount and the total units. And so I guess somewhere on a piece of paper, or I guess over here in this cell, you would put 155 divided by 21,000 is $7.20, which is what the amount that the sale happens at, right? And then you have another purchase, and so you add up the units again, 18,123, 120. The average here is $6.84. It's all the numbers we've seen before, but I guess what I'm trying to show, without maybe going through everything again and making people truly roll their eyes and fall asleep, is that there's being able to do this, obviously, but then the fact that, you know, you're not just writing this out on a piece of paper or doing it in Excel. For me, you actually have to follow the structure that Wiley is giving you. So, you know, make sure that you kind of understand where to put things on this table, because I think that could end up tripping people up, even if they understand the question and how to answer it. I wouldn't want you to get stuck because you don't know where to put a number, right, on this thing. So if you have to screenshot this or whatever and look at it while you are studying, or have it as a reference, if you feel like you're going to forget how to structure your answer, if this question comes up in a test, then so be it. If we were doing a testing class and you were just doing this manually, I would accept, you know, any structure, because as long as the answer is correct. But unfortunately, with you know, being online, you kind of have to follow whatever structure the computer wants, so that the computer can grade your work appropriately. Does anybody? I feel like I've spoken for a very long time now, and I know it's kind of the nature of the beast here. But does anybody have any follow-up questions about the perpetual inventory method, or anything like that? Anything about what I just discussed? Okay, so, you know, I know that, again, this might seem bizarre. We're going over this homework, but I want to say, just consider this a type of review as you gear up to study for chapter 8 and 9, right, for the test. So, you know, it's telling if you're thinking to yourself something like, oh, I don't remember anything, or what is she talking about, or, you know, if any of those types of thoughts are going through your mind, then you know you probably need quite a bit of review before you actually have the test, or take the test. So, you know, bear that in mind. The next question is dollar value LIFO. The way this question is presented versus number 7 is interesting, because this one, okay, so just reading it, it says, they have only one inventory pool. They adopted dollar value life on December 31, 2021. The inventory on that date was 214,000. So that's the base layer. Remember, we went over this, the base layer, the starting inventory. And so when you start your dates, you have to have a line for the base year. See here how they have 12/31/2021. That's all. The base index is 1. You need to include that. That's like the first error that people sometimes make, is that they just ignore the base year. You can't, okay? And then after that, they start giving you information from the next year, from 2022. Now, what's interesting about this is they don't give you the index or the indices for each year, like what we had in the class example. They actually give you the year-end inventory costs, and then they give you the ending inventory at base year costs. So it's already converted, right? So you were basically being called upon to understand the relationship between the ending inventory at year-end costs, the index that you use, and then the ending inventory at base year costs. And so in the end, all you really needed to do was, like, let's take this first one as an example. To get to this number, 1.05, you just needed to say ending inventory at the year-end cost 260,400, divide that by 248,000. That tells you that the index is 1.05. And you do the same thing for each of the other examples. I'll just show you quickly. I'll come back to number 6, but I'll show you quickly for number 7. They give you the index, right? And so you can put in the ending inventory year-end cost, you put in the index, and you have to solve for the inventory at base year cost, right? That's the other way around, for lack of a better way of saying it. So you need to be able to understand the interplay between the index and the 2 years inventory amounts to be able to answer the question, regardless of which way they present it to you. So this is the base layer. So when you convert the 2022 inventory to base year cost, you get 248,000. That shows you that the inventory amount has gone up, right? In fact, it's gone up by 34,000. That tells you that a layer of inventory was created in the current year, 2022. So the way you start to figure out which years this ending inventory relates to is you always start with the earliest year. So 248,000 is split between 214,000 from the base year, and then there's another 34,000 layer that was created in 2022, but it's at base year cost, which is not the correct amount. It needs to be written back up to current year or converted costs. So in the end, the inventory ending inventory, for 2022 is the base year's 214,000 plus 35,700 from the current year, which gives you 249,700. And so we continue right year over year. The next year is 302,000. It's more than 248, which tells you a layer must have been created in 2023. You always start by splitting out the earliest year. So you first say this belongs to the base year. Then you look for the next earliest year, which is 2022. So 34,000 belongs to 2022. And then you've still only priced out 248. So then another 54,000 is the layer that was created in 2023. Notice again, we spoke about this when we did dollar value LIFO. When you convert to the cost of the year that the inventory layer was created. So over here, even though we're in 2023, where the index is 1.15, for the layer that was created in 2022, you use the 2022 index of 1.05. For the layer created in 2023, you use the 1.15, and so it's 311,800 once you add all these three together. And then finally, it's 2024. Notice that the number dropped. It was 302, so it dropped. So automatically, you should know that a layer could not have been created in 2024 because the ending inventory number is less. Again, you start with the earliest year, you split out the base year, then you split out 2022. Once you get there, you realize you only have 44,000 left, which means that 10,000, right, of the 2023 layer was actually sold and no layer was created in 2024. And again, you convert these at the index or the rate that existed in the year when the layer was created, and there's your ending inventory number. Questions on dollar value LIFO review? Okay, so I'm not going to go over number 7 because it's basically the same thing. I mean, it's so similar that it actually also doesn't have a layer created in the final year. The only difference was that they gave you the index year instead of the ending inventory at base year costs. If you know how to do number 6, you know how to do number 7. Number 8, this was going into the codification to look for different to look for the specific citation for different topics. Okay, so I'll show you the first one, and I'll remind you again how to go into the codification. Well, I'm already in it, but I'll start it from scratch. It's so important because again, you probably will be faced with having to look at this codification at some point in the future if you haven't, done so already for other classes besides this one. So I gave you a codification link on our Blackboard. Some people use it already, obviously, to answer the questions, or you could just go straight to the FASB website and you can get to the codification through there. I have to find mountains or hills. Hopefully I found them all. Okay, so I'm accessing the basic view. I go to assets. I know that inventory is 330, so that's where I'm starting, and I'm clicking on overall. That's how you access the codification for inventory. And it's asking you the 8-digit code that describes the meaning of cost as it applies to the initial measurement of inventory. So the hint is initial measurement, because normally there's something about initial measurement in all of these asset codifications. And sure enough, there's the initial measurement. So see how the numbers run. It's 330 as the topic. There's 10, right? If you look at what they ask you, they're looking for a topic, a subtopic, a section, and a paragraph. So topic is 330, subtopic is 10, initial measurement is the section, and then the paragraph, we have to go and check it out. It talks about cost basis, so this is probably it. So then you see over here for 30-1, the primary basis of accounting for inventory is cost, which has been defined as the price paid or consideration given to acquire an asset. And then we're talking about all the applicable expenditures to bring it to the location and condition for its intended use. So that's why for this one, you put 330, 10 is the subtopic, 30 is the section, and 1 is the paragraph. Now, when you were cursing me, when you were doing this homework, and you're like, why is she making us, right, do this? This is really tedious, etc. I get it. But this is just me trying to expose you to make sure that you know at least where to go to find the codification, how you can access it without having to pay $1,200 to get access to it, and also to understand that everything that we are learning in this class is somehow housed eventually in the codification, okay? Because you can see everything from general principles, presentation of financials, assets, liabilities, equity, revenue, expense, other transactions that maybe don't fit into the exact, topics above, industries, there's a glossary, everything that we are doing, all roads lead back to, the accounting principles, and the codification is where they are held. Will I ask you to find stuff in the codification in the test? No. Okay, so hopefully that's a sigh of relief for everybody. This is more about enriching your experience so that you can understand where the information that I'm giving you every day and what's in the textbook, where it comes from. If you are still curious about how to reach this information, because maybe you couldn't find all the answers, or maybe you actually accessed the answer and you kind of just wrote it in because you were under time crunch, notice that you have access to the solutions. Once you've done the homework, you can actually see the solution, right? And if you wanted to practice, you could go, you could go back into the codification and actually go and look, like this agriculture thing. I could actually go and look for the answer, right, that was given in here and see if I can figure out how to get there. So you can basically do it backwards to make sure that you know where to find the stuff. So that was the chapter 8 homework. Again, quick synopsis. There was, what to include in inventory, goods in transit, consignment goods, right? And important topics. And there you have to be aware of whether you're the buyer or the seller. What are the shipping terms? Did you include or exclude the stuff already? And what are you supposed to be doing? Should you be excluding or including? And then you had all your FIFO, LIFO, average cost stuff for periodic and perpetual. Perpetual is by far more, challenging to calculate, especially the average cost one. So, spend some time reviewing that. And then, I mean, as we move through the topics that you did, you had the dollar value LIFO, and then ultimately this codification question. So, if you're thinking about what would I ask on a test, I mean, these are the topics, right? That were main topics in the work. So I'm not gonna throw something in the test that is now like something out of the blue that never came up in class, and you're just like, what? So there are other topics, maybe minor, there are other classwork examples that didn't come into the homework. Some of those are can possibly come up, but I will tell you, like, I know we did a lot of journal entries for purchases of inventory under periodic and perpetual and so on, purchases and sales, sorry. So I will, once I'm done, figuring out how I'm splitting the points, I will let you know where to spend your time. But please note that the things that have come up in this homework are obviously important topics, but I won't ask you to go into the codification for the purposes of the test. Okay. Any other questions around I don't know, like anything that I just said about chapter 8 homework, or how I'm planning to test chapter 8, or I don't know, just talk to me if anybody needs further clarification on something.
How many questions is gonna be on the test?
How many questions? Yeah, I mean, I can't say for certain right now, because I'm trying to see within the system how I can split the points. It's tough because between chapter 8 and 9, there's at least probably somewhere between 6 and 8 topics that are important, but I know that I won't necessarily be able to have exercises for all of them. So I normally try to have somewhere in the arena of 5 to 7 exercises, and some of them are short. So for the exercise portion of the test, and then the multiple choice portion of the test is somewhere between 5 and 10 multiple choice questions. The quiz is a separate activity, and the quiz will be 10 multiple choice questions.
Wait, so it's like multiple questions only?
No, listen to what I'm saying. 10 multiple choice questions on the quiz. That is separate from the test. The test will also have a few multiple choice questions, but it has more exercises than multiple choice. So normally the exercises will count somewhere in the arena of 80 or 90% of the points on the test, and the multiple choices, somewhere like 10% of the points. All right. So you definitely want to be able to actually do these questions, and I'll sit later this evening and try and see if I can resolve in my mind and in the system exactly what I'm going to ask, so I can send out this prep sheet. But it may come tomorrow evening. It just depends on how my schedule goes. Okay. Anything else? All right. So that's the end of chapter 8. Chapter 9's homework. I mean, I've said this before, but I'll say it again. Chapter 9's homework is due, and it's due like this for a purpose, because The homework should be due before the test is available so that people can still get any type of help that they need. The homework for chapter 9 will be due on Monday, the 18th at 6 p.m. And what will happen is on Wednesday, the 20th, I will go over the homework with you guys, just like how I went over the chapter 8 homework. I'll go over the homework with you guys. I mean, ideally, what should have happened was if we had had class on Monday, I would have finished going over the chapter 8 homework, but it's fine. So on the 20th of October, I'll go over whatever we need to go over for the chapter 9 homework. So at that point, you would have not only completed all the homework, but you would have also had a review of all the homework from me. Okay, so again, mark your calendars if you haven't already. Some people already started. They've sent me questions via email. Great. If you haven't started, today is the 13th. So you basically have 5 days and a few hours to get the chapter 9 homework done. So, please plan your life accordingly, because your best bet on trying to make sure that you actually understand these concepts is to do the homework, and to obviously do the classwork and pay attention in class, but the homework is important. So we'll take a break here at 11:30. So for the next 10 or so minutes, I'll just get us into our next topic. Remember we're just moving through the line. We're going 8, 9, 10, 11, 12, 13, 14. Those are the chapters that we cover for this class. So the next 2 chapters really are actually just like 8 and 9 were linked together. 10 and 11 are also linked together, and they will form part of of the next test that we will have in the future. So chapters 10 and 11 have to do with property, plant, and equipment. So you're talking about what we would also sometimes refer to as fixed assets, and then also intangible assets. Intangible assets being, assets that have obviously some type of value. There's a future benefit, but there isn't a physical substance. So you're thinking about, copyrights, trademarks, patents, things of that nature. And we'll also run into an intangible asset called goodwill as we work through this chapter and the next chapter. So chapter 10 is about the acquisition of property, plant, and equipment, just like chapter 8 was about, the acquisition and initial measurement of inventory. And then chapter 11 will be about depreciation and impairment, which has got to do with the subsequent measurement of property, plant, equipment, and intangibles. So in chapter 11, we'll run into, again, things that you will remember from before, like straight line depreciation, units of activity or declining balance, and then calculating impairments and so on. So in the I guess lead up to chapter 10, what you should be really concentrating on for this chapter is when do we what we call capitalize, right? A payment that we are making, as opposed to just expensing it. So when do we make something an asset versus making it an expense? And remember, an asset is kind of, if you want to think of it in really just broad terms, it's like an expense waiting to happen. Because let's think of an asset building. You put an asset on your balance sheet, but you're going to depreciate it over time, and that depreciation is an expense. So if I buy a building for our business today, my question becomes, do I put it as an expense, all of it today? So if the building is $1 million, do I just expense it all today? Or do I make an asset and then expense it over time? So obviously we know already, and you guys know this, that if there's this future benefit that we're expecting to get, we're going to make something an asset. And that is what we mean when we say capitalize. And this will come up a lot. Capitalize means to make something an asset. So as we go through this chapter, there's a lot of different topics floating around, okay? And I'll try to keep them as much, to alert you as much as possible when we're moving on to the next topic. But the real focus of what we're doing is trying to figure out, for different types of assets, what should be included in the cost of that asset. So if I buy a piece of equipment, I'd include the cost of the equipment, obviously, but should I also include, any type of transport that I pay for the equipment? What about installation? Can I include that in the cost of the asset? What about testing, right? Should I include the testing? What if I pay insurance while the equipment is being transported? Should I be including that? What if I pay insurance for the next year, while the equipment is in my building? Does that qualify as part of the acquisition cost? So we're asking these questions, and while we ask them, you always want to have in your mind, this is very important, because the same phrase applied to inventory, we just saw it in the codification. The same phrase also applies to property, plant, and equipment. We include in the cost of the asset, obviously the acquisition cost of the asset, and then all the expenses to get it to the location and the condition where it can be used. All right. And they normally say all the reasonable costs, because I mean, if you decide to fly the equipment over on a private jet, because you don't want to wait for the ship to come in, the cost of the private jet, you won't be able to capitalize all of that, because it has to be a reasonable transport cost. But that notwithstanding, you include in the cost of the asset, obviously the cost of the actual asset, the acquisition cost, but then all the expenses to bring it to the location and the condition for its intended use. So if you think about sales tax, you have to pay sales tax in order to get the asset. You're not going to be able to get it from the vendor if you don't pay them the sales tax. You have to pay transport if the asset isn't actually like right on your doorstep, being, you're purchasing it from next door or something. You have to pay for installation, if it's something that has to be installed. It's not just a plug that you're putting into a wall, but there's an actual installation that has to happen. And if there's testing that needs to be done to make sure that the thing is actually working properly, that's all part of the cost to get it to the location and condition for its intended use. So those all get capitalized, right? All those costs will end up being made into part of the asset. But we definitely differentiate that from, let's say, repairs and maintenance. Let's say after you install the equipment and you're using it for a while, suddenly something's happening and you have to bring someone in to make a repair or to do some maintenance. That won't be capitalized as part of the cost of the asset, because it's not adding to the useful life of the asset. It's just maintaining it at a position where it can function. All right, so that's kind of me just giving you a flavor for the types of things that we will be looking at for each of these assets that we deal with. And I'm just going to go, this is the summary documents. There's a lot of documents in the Zoom notes for chapter 10. Sorry, there's just so many topics for chapter 10 that I had to do. Like some of the solutions are on different sheets because they need to be in Excel. Some are just in a Word document. But if you actually want to follow the notes, these are the notes, okay? And there's no way on Blackboard for me to shift things around so that I can put the more important documents at the top, but these are the notes. So going into the notes mirror to a large extent what's happening in the textbook. I mean, you read the textbook, read the notes, whatever works. I'm doing the notes combined with the textbook at times, but I'm doing the notes because it just kind of wades through a lot of the fluff that's sometimes in the textbook and helps us to just focus on some of the really important things. So when we first start out, looking at the acquisition of the assets, we're looking at what are the types of assets that we are dealing with in this chapter. And then, how do we value them at acquisition? Meaning, is it historical cost? Is there something else that we should be doing? What are we going to record when we buy these assets? So property, plant, and equipment is the asset that, one of the categories. The other one is intangible assets. So just to go through this, it's probably stuff you know already. The major characteristics of PPE: they are acquired for use in operations and not for resale. So this is not inventory. This is not something that you bought, but it kind of looks like property, plant, and equipment, but you're actually not using it in your business. You're planning to sell it. It has to be something that is being used in your business. They're long-term in nature and usually depreciated. Obviously, we know that land is not depreciated because it's the useful life of land is indefinite. In order to depreciate something, you have to have, a cost, and you have to have some type of estimate of useful life. And so, I mean, in its extreme form, you're asking, like, how long will the earth be spinning on its axis? Like, who knows? We'll be long gone and it will still be spinning. So we're not going to depreciate land because the useful life is indefinite. But and this is happening more often now because of climate change, whether you want to believe it or not. I mean, we just went through Hurricane Ida and a few other rainstorms that were pretty rough in many ways. Sometimes there's a very significant decrease in value that occurs in the land, maybe because some of the land is swept away or it's underwater, or even with the fires in California. I mean, you can see that there's a lot of loss there. So some of that is lost, but some of it may also be some type of accelerated depreciation. For our purposes, land is not going to be depreciated, okay? But you're accountants, you want to know, you're smart, so you should know that there might be occasions where land would have some type of accelerated depreciation because there's some significant damage. And then obviously they have a physical substance. You can touch them, you can see them. This includes natural resources. At the start of the chapter, they talk about the different assets that different companies have, and they talk about international paper company that's making paper, and it has timber, right, as part of its assets, and its natural resources or reserves are part of this company's assets. So think about that, because it's kind of like, okay, so the timber is also becoming inventory, but somehow it's also part of the assets. But that's because, I mean, you're talking about big swaths of land full of timber. They're not being sold immediately, they're being used to make paper. So in some way you have to, what we say, deplete, which is the same as depreciation, but just for natural resources, you have to deplete those timber assets. Okay, so that's the property, plant, and equipment. And then the intangible assets, I just said this, right? There's no physical substance. So you kind of have a piece of paper, where it's written on here that this is the copyright or the trademark or the franchise. The paper's worth a few cents, maybe $1. That's not where the value lies, where the future benefits lie with this asset. The future benefit is obviously whatever revenue stream is going to be generated because of because of the agreement, whatever that agreement may be, or, because of the ownership that the paper represents. Not always clear how the benefits are going to roll out. That's why some of these things, are just being amortized, is the word for depreciation for intangible assets. They're just being amortized over some period of time, somewhat, arbitrary, but that's, and we'll see more of this in chapter 11, but that's how it goes, because it's difficult to say how long the benefits will actually, exist, except for goodwill that is not amortized but is impaired. What is goodwill? We'll talk about this more later, but goodwill, not talking about the Salvation Army, like where you go to buy clothes and all of that stuff. That is goodwill of a different nature. Goodwill in this sense is the excess amount of money basically that a company pays to buy another company over and above what its assets minus liabilities is worth at fair value. So if you have a company and I value your company and I say your company is worth 10 million, but I'm going to pay 12 million it's because, so the extra 2 million that I'm paying is basically the goodwill that I'm factoring in. And why would someone do that? Because when I buy your company, I'm basically buying the reputation, I'm buying the access to the customers, I'm buying revenue streams and so on. So, you know, I mean, there may be a customer list, but in general, goodwill is some representation of future revenues that I'm paying extra for. So those are some of the intangibles, and we'll go on break here at 11:30, but when we come back, we'll start talking about which costs do we capitalize and which costs do we expense, and then we'll actually go into individual assets to see, what do you include in the cost of those assets when you buy them, and what do you exclude. And eventually, a lot of the work in this chapter is going to be around, calculating what goes into the cost of the asset, either if it's being acquired, if it's being built, if it's being exchanged, like in a barter transaction, non-monetary exchange. And then the last part of the chapter, which is probably also the most challenging part, is something called interest capitalization, where you're actually going to calculate interest on loans related to the construction of an asset. And part of that interest you can add on to the cost of the asset, because the FASB is saying that you took out the loans or you're using some of your money because you're building the asset. So it's also part of the cost of getting the asset to the location and condition for its intended use. All right, so we'll break here until 11:40. I'll be on the line if someone has questions for me. But go and enjoy your break. Okay, so we're back from break. I did take attendance. I just have two people who are not on, and I'm just checking that that is in fact the case. I don't have Antora Ghosh. I don't see you here, just calling out the name in case for some reason I missed it. And Ivana Hussein is also not here, right? Okay, so I'll follow up with them. Okay, so starting out with what should be capitalized. Remember this language? We said capitalized means making something an asset. So they're saying what costs should be made into an asset instead of making them into an expense. And they're talking about how you can buy or acquire assets. It can be bought. You could exchange one asset for another. It could be via a lease agreement, a donation. You could construct it yourself, or what we call a business combination, which is when one business buys another one. Combination that happened a few years back, but it's probably names that you'd recognize, is when Amazon bought Whole Foods. That's a business combination. So all the assets that belong to Whole Foods now belong to Amazon because Amazon took over a majority stake in Whole Foods. I don't know if they own 100%, but they certainly own more than 50%. And it's through these business combinations that we end up recognizing goodwill. There was goodwill in Amazon's purchase of Whole Foods. So when we acquire assets, historical cost is the basis for valuing those assets. Historical cost means like basically what did you pay, or whatever the values that you put on the transaction is on the date of the purchase or the acquisition. So that's in history, right? You're not putting the assets in at what their current fair value would be. That's the differentiator. When you look at international financial reporting standards or international accounting standards, they actually do allow some writing up of property, plant, and equipment to fair value, but US GAAP stays with historical cost. So you remember that, right? Historical cost, excuse me, measures the cash or cash equivalent price of obtaining the asset. And here's our words again, bringing it to the location and condition necessary for its intended use, right? So charges like freight cost, sales tax, installation, all of those things are part of the asset's cost. And remember, it's cash or cash equivalent price. So sometimes you acquire something without actually paying cash, and we'll see this when we do non-monetary exchanges, and you have to try and figure out what the amount is that you'll record the transaction at. If there's a future benefit, the costs are capitalized, and if it's only for in the future it's capitalized, but if there's just a benefit in the current period, then you just make an expense. This is the typical example here, is that repairs and maintenance would be an expense, but a replacement of, let's say, the roof of a building, or a replacement of an engine of a car or something like that, that would be capitalized because that is improving the benefits that you're getting or increasing the benefits that you're getting from the asset in the future. Um, and here's the way that you think about this. This is kind of what I just said. You add to the assets cost any cost that will actually improve or replace, that is for improvement or replacement if there's future service potential, meaning it's extending the life of the asset. This is exactly what I just mentioned. If you're replacing the engine versus just doing an oil change, right? An oil change is just repairs and maintenance. Engine replacement is capitalized. And then you allocate that asset over time to expense through depreciation, right? So it's not like you capitalize it, other than land. It's not like you capitalize the asset and it never gets expensed. It will get expensed to be, although this is somewhat of an old-fashioned concept, but it still comes up in accounting, that you're basically matching the revenue and the expense. So the revenue that the asset is generating is being matched every year with, the depreciation expense, the cost of the use of the asset. You cannot write up the property, plant, and equipment to reflect a fair value, because it's, what GAAP is arguing is that That would be like a hypothetical transaction that hasn't happened. So I'm sitting in this house. If I think that the value of the house has gone up, by $1 million, it doesn't matter. I still have to keep it on my books at the original cost because the transaction for the extra million hasn't actually taken place. So it's not necessarily a reliable amount. And also you can't record a gain or a loss before the asset is actually sold. All right. So that's their argument for sticking to historical cost. It's reliability, is the argument. When the international accounting standards talk about the fact that you can write up some of the assets, they're referring to relevance, right? They're saying that the historical cost amount may not be as relevant anymore. I mean, think about where LaGuardia is located. I know we're not on campus, but Long Island City for the longest part was, an industrial area that nobody wanted to be in, and now it's like gone completely crazy and it's so expensive now. So if you own a building in that area, the historical cost of that building is probably almost nothing. Whereas, the fair value right now is millions of dollars. But according to GAAP, you can't write up the building until you basically only recognize any gain when you actually sell the building. All right. So that's the way it is. It's kind of like with inventory. Remember, we could only write down the inventory if we couldn't get the money for it. We're not allowed to anticipate a gain on the inventory. We'll recognize the gain when we actually sell the inventory to our customers. Any questions on this? I know there's a lot of theory, a lot of talking, but this is the nature of the start of a chapter. We will get into some examples, but anybody have questions about anything? All right, so I'll push on. Okay. Um, so now we're getting into the cost of different assets, cost of equipment, land, buildings, and then we'll do some examples there. Then this natural resources and also what we call assets retirement obligations. So when we're being asked what to include in the cost of equipment, I don't know what happened over here with this bullet. It should be, yeah, I don't know, whatever. I guess it's neither here nor there, but let's see if we can make it a little bit less chaotic here. Okay. So you include obviously the purchase price of the equipment. I already told you sales tax is added, any other expenditures that are subsequent to acquisition, but prior to actual use. All right. So anything to get the thing to the point where you're going to use it. If there's a discount on the equipment, you have to take that off of the amount in your books as well, because you have to include what you actually paid for the thing, right? And then so it's transport, freight charges, insurance while the asset is in transit, not after you've already started using it, but while it's in transit, assembly and installation, preparing the facilities and any testing costs. Okay, those are what go into the cost of equipment. And why do we care? Well, let me see if I can find one of the reasons. I'm trying to. There was a massive fraud. I mean, it's not just a massive fraud. That's the reason, but this kind of helps the situation to understand why we care so much. Like while you are possibly bored and rolling your eyes at me because it's like this is just going on and on and on, right? Why do we care and why are we so detailed about all of this? I can't remember which page this was on. I'll find it, but there was a fraud in like 2001, 2002. It was around the same time as the whole Enron scandal. There was another fraud in a company called WorldCom. I don't know if anybody's heard. Let me see if I just do a simple Google search. I know it's in the textbook, but I just can't find it. Okay, so we'll go to, I mean, I know Wikipedia is not the greatest source, but I'm not going to quote it in a paper or anything. But this WorldCom scandal, right, happened in 2002. WorldCom was a company, and notice as it was, right, because it was so, the scandal was so big that they're basically gone. A company that like provided cabling and telephone long distance cabling and things to various places. And they made a whole scheme where they would make their profits higher. And the way they did that was to, instead of expensing certain things that should have been expensed, they capitalized those items. So it's like saying that I'm paying let's say something simple, sorry. Let's say something simple like I have my Con Edison bill that I have to pay every month. That is an expense for me, obviously, because I mean I already used the electricity, so there's no future benefits. I can't make it an asset. That's an expense that should go into my income statement. But what they did with certain types of expenses to the tune eventually of $11 billion, they admitted $11 billion of fraud, was that items that should have been expensed on the income statement and thereby would have made their profits less, they actually decided to capitalize and put them as assets on the balance sheet. So yeah, you can see it was labor for capital projects and other expenses and all kinds of stuff that was supposed to be expensed, that ended up, I mean, you can go through the whole thing. I'm not even going to go through this. We don't have the time, but this is a classic fraud that many people know about. I mean, I know 2002 is very long ago. It's almost 20 years ago, but this was a massive issue. And it goes back to what we were just talking about, in that, if you say, so what, who cares, why are we doing this? As accountants who are journalizing these transactions in the companies that we work at, or if you eventually become an auditor for an audit firm, you have to know which expenses are allowed to be capitalized, made into assets, and which aren't, because an error or fraud in that respect can actually be a lot of money, and it could end up being, the business could go under if it's a fraud, and if it is an error, they could continue doing it for a long time. So we do need to know why, or if we do need to know why, we have to learn this, so that you can make sure that people are not capitalizing things that they shouldn't be capitalizing, and vice versa. So for land, if you're buying land, you obviously include the purchase price. If you've ever bought any kind of property, there are things like closing costs, there are attorneys that have to be paid, there's a title transfer amount that has to be paid, you're recording in the books of the state or the city that you now own this property. All of this costs money. Then if the land needs to be rehabbed or cleared or whatever, this is all about getting it to the location and condition where it's ready to be used. So all of that can go into the cost of the land. If you take over a mortgage or a lien on the property, let's say the person who owned the property before was not paying, and so it's actually like a foreclosure where you're buying the land. If you agree to pay for the stuff, then that is part of the cost, right? Because a condition of you actually becoming the owner of the land is that you have to pay off some tax lien and so on. And then if there's any improvements to the land, so you decide to put up a fence, or you decide to put up something other than, I mean, I'm not talking about a building and so on, that's a separate asset. But if you make some improvement to it, then that's going to be a part of the land cost if the improvement has an indefinite life. So, and a fence is probably not going to be part of the cost of land because it has to have an indefinite life, but there may be other improvements that have an indefinite life. Also, if you remove old buildings and stuff, so this is typical, like if you go work for property development company, something like that, that could very well be someone's job in New York because there's so many property developers. You could end up having to figure this out, right? So often the property developers will buy a piece of land with a building on it, but they take the building away and build something new. So the cost of removing an old building from the land for the purposes of constructing a new building is charged to the land account. So when you're sitting and doing the books at, ABC Property Development Company, you need to know that when they say it costs $10,000 to remove this old building, that isn't an expense that goes through the income statement. That is actually going to form part of the cost of the land. Okay, which makes a big deal because remember, maybe it's not just 10,000. I mean, demolition could cost hundreds of thousands of dollars. So if it goes as part of the cost of the land, it will never be depreciated, which means it will actually never hit your income statement. Whereas if you make the mistake to put it in as an expense, you're making your profits less when you really shouldn't be including it in your expenses at all. Okay. If you sell, maybe you break down the building and there's materials and stuff that you can sell, that will also reduce the cost of the land. So let's say we break up a building that's on the land. So the cost of breaking up the building, we put as a part of the cost of the land, but then we're able to sell some of the parts of the building. Then we have to decrease whatever we get as the sales price, we have to decrease the cost of the land by that amount. So it gets a little bit, tricky. Limited life improvements, if they're made, they can be depreciated. So this is where the fences and stuff comes in, fences and driveways and so on. They'll be depreciated even though they're being made to land, but they have a limited life. So you can actually depreciate them. And if you're holding land speculatively, so maybe someone buys a piece of land in Florida and they're saying, I just want to see like how the land prices move, I'm going to hold it for a year or two, and then I'm going to sell it. That's an investment. Okay. That's not a property, plant and equipment. That's a totally different classification of assets. And obviously, if you're a real estate company. So I'm not talking about the development stuff. I'm saying real estate, which is the companies that are actually selling the land to the property developers. Then your land is going to be inventory, right? So you're always thinking about, what type of business are you in, and make sure that how you classify your assets is in, is correctly in line with the type of business that you are actually in. So we'll just continue a little bit with me talking for cost of buildings, and then we'll do two quick examples here. These examples aren't too extreme at this point, and then we'll see how the time goes. We'll probably just keep doing examples after that for the next few topics. So buildings, so we've done equipment, cost of land, now cost of buildings, all the expenditures related to acquisition or construction. So this could be materials, labor, overhead costs during construction. This is if you're constructing a building, or if you're buying it, realtor commission, legal fees, building permits, whatever you're doing, that all goes part of the cost of the building. It's acquisition costs or construction costs. If you have to prepare the site, like maybe you have to excavate in order to lay a foundation or whatever, those things are also forming part of the cost of the building. So once you've cleared the land and you're now starting to construct the building, that's when the costs have to start adding onto the building, no longer onto the land. So there you can see again why it's important to know what gets included where, because you could also be allocating expenses that should be part of the building onto the land. And again, remember the building actually, attracts depreciation, the land doesn't. The building's historical cost, if you sell the building, you want the historical cost to be correct so that you are recognizing the correct profits, and you don't want to be taxed more than you should be. And if you don't make the building's original cost the correct amount, you could end up paying more tax if you make the original cost too low. All right, so as we're going, I'm trying to give the argument for why, listening to me talking for an hour here is useful as accountants. I know it's a little bit dry, but it's going to get better as we go through. So in this, just like with chapter 9, in chapter 10, the examples are at the end of the theory. They're not in a separate paper. So I'm scrolling here to to number one. So I'm going to give you guys, just to wake everybody up a little bit, I'm going to give you, let's say 4 minutes to do number one. I know it's a lot of time, but I'm going to give you 4 minutes, and then I'll ask someone to raise their hand at 12:04 to give me the answer for what amount should be recorded as the cost of the land. Okay, so you have 4 minutes until 12:04 to answer that question, and then someone raise their hand so that I can go through it with you. Right. Who's going to be the, I guess the person, aha, Cora, thank you. Let me get into my document. Okay, so example one, Cora, go for it.
Okay, so I think it's gonna be 28,400 in total.
Okay, so walk me through what you're doing. Are you including the
So
cost of the land?
yes, so the cost
Okay.
of the land is 27,000,
Mm-hmm.
and I added the closing cost,
Okay.
1,400.
What do you think about the building removal?
I think it's gonna be recorded separately, in
Okay.
my opinion.
Okay.
Yeah,
So let's see what
that's
the,
why.
right, right. I hear you. I'm gonna check you over here by going to up to the theory and seeing what they tell us to do. Okay. Look here.
Okay.
The cost of removing an old building from land purchased for the purpose of constructing a new building is properly charged to the land account. Now, I can see your argument because they don't tell you in the question whether the old building is being removed to construct a new building, right? It just says that an old
Yeah.
building was removed. But in this case, I guess we're making an implicit assumption that the old building is being removed to construct a new building. So I'm actually going to add the removal of the building as part of the cost of the land. But I think if you wanted to argue the point with me, I think you could argue that the question, I'm giving you the arguments, right? I think you could argue that the question is vague in that, it's not necessarily saying what the purpose of removing, this always happens, sorry, what the purpose of removing the old building is. All right. But I think
Yeah, okay. Yeah,
sorry.
I thought it was gonna be separate, but since removing is also a sort of construction, a type of
It's
construction.
got to do with getting the land. Remember the thing that always should run through your head is the cost of getting the asset to the location and condition for its intended use. So the removal of the old building is part of getting the land to the condition for its intended use. We don't want the land with the building on it. We want to use it differently. I just think that, the question is silent on whether they're actually going to construct a new building. And the theory seems to state that, it is about, removing an old building to construct a new building. So you could go either way. But I think for safety's sake, if there is removal of an old building in the question, just assume that it's part of the cost of the land.
Okay, got it.
All right.
Thank you.
Thanks for participating. Now we shall move on to example 2. And I'm going to throw it to you guys as well. Let me get to the question. This has also got to do with what gets capitalized. You can see how long chapter 10 is. Sorry, coming attractions, right? But it's not super hard. Some of the stuff is not that bad. Yeah, no, it's the professor saying it's not hard. So, who knows if it is hard or not. Okay. So in number 2, they're asking you whether for the following costs, whether they should be expensed or whether they should be capitalized, right? Should it be an asset or should it be an expense? So remember what we spoke about? The asset is when you're going to get future benefits, future life out of, future use out of this thing. And expense is when you're kind of just getting the benefits right now, you're fixing something and so on. So go ahead with number 2. I'm going to give you until, let's say, 7 minutes. So I'm going to give you until 12:15 to work through these 5 scenarios. And you either say whether it should be an expense or an asset. And then someone else can raise their hand and walk us through the solution. It's okay if you're not sure. It doesn't matter. We're all learning together. Okay. So I need a volunteer at 12:15 to walk us through this. Right, who wants to, oh, let's have a hand. You can just take a shot, guys. This doesn't have to be perfect. If you don't know, just say I don't know and answer the ones that you do know, and other people can chime in. So do I have a hand of someone who wants to take the first stab at this? I see something in the chat. Okay, so Mdadul, can you, I see an amount. I have no context for what you're telling me. Can you talk, or is there too much noise in the background or something where you are? Or can you type in the chat what the 585,000? Because the numbers that are on this question don't add up to 585,000 at all. So I want to know what you're thinking. You want to type a little bit more for me in the chat, or can you talk? Okay, no problem. Well, thanks for taking a stab at it. I think because you're saying what should be this thing is saying what should be expensed. So you're saying that all these amounts should be expensed, or are you saying that all of them should be capitalized, made into an asset, or should I let you go for now and ask someone else? Ora, you want to save everybody? You want to save Mnidal? Mnidal, thanks for participating. I understand that some people are in homes and things where there's a lot of noise, so I get it. So Pura is gonna rally for the group today. Talk to me, Pura. What are you thinking?
Okay, so I might be wrong again,
Yeah,
but
that's fine.
I I think it's the 200 for oil change on the delivery truck.
Yeah, that's all that should be expensed. Is that what you're saying? Yeah,
Yeah,
that's right. Okay, so I'll write that down and then I'll go slowly through each one and say why they should or shouldn't be. So the 200 for the oil change is the only, right, expense.
yeah,
Everything else is capitalized and sorry, capitalized, but it's not so obvious because some of these things sound a little bit strange. Okay, so let's go
yeah,
one by one, right? So 13,000 paid to rearrange and reinstall machinery. So when I read that, it kind of sounds to me like, is that really, adding to future benefits? Because it sounds like you're just moving stuff around. But you'll see even in the textbook, it specifically talks about rearrangement and reinstallation of things like machinery. And in this case, I guess there's an underlying assumption that it's going to improve the performance of the machinery, the rearrangement. So the 13,000 would be added to the cost of the asset. Again, I believe I can look up the page if someone wants to me to do that. But the book specifically, I mean, the accounting standard specifically mentions rearranging and reinstallation as part of adding to the cost of the asset. The 200,000 paid for in addition to the building, obviously you're building something, so that's an asset. The payment for the oil change is expense, right? It's not adding to the useful life of the truck. It's just maintaining it at the same level of performance. So that's the expense. And remember the question asked which item is being expensed. And then, this can be argued 700,000 paid to replace a wooden floor with a concrete floor, like, okay, seems odd. Like it almost seems like a taste, someone's tastes are changing or something as opposed to useful life. But I think if you think of the nature of concrete versus wood, concrete is going to last longer, than wood. So you would be able to add this onto as part of the cost of the asset because you are extending the useful life of the floor by using a material that clearly has a longer useful life than the material that is currently there. And then 2,000 paid for a major overhaul on a truck, which extends the useful life. I mean, the last part of that sentence tells you what you should be doing, that the useful life is increasing. So that should also be an asset. So again, in the end, the only thing that's an expense is the $200 that's paid for the oil change. This one, in my opinion, is, you could question like, why is this an asset? And like I said, it's specifically mentioned as something that would be capitalized. And I would also say this one could be questioned as like, why should this be an asset? It sounds like you're just replacing a floor with a floor, but you think about the type of floor. Concrete has a longer useful life. All right. So again, this becomes quite detailed. You have to be sure that you understand why something is capitalized. It has to extend the useful life. Don't be WorldCom and capitalize expenses and end up with a big fraud, and everybody goes to jail. Do not pass begin monopoly style, right? So that's kind of the crux of the thinking around. I mean, I haven't done every possible type of question that can exist, in terms of how to account for the cost of stuff, but I don't have to, because you have to keep the principles in your mind, that you are obviously including the cost of acquisition, the actual thing, and then all the expenses to get it to location and condition for its intended use, and any subsequent expenses. If it's adding to the future useful life, the future benefits of this asset, then you will add it on. It's extending the useful life. But if it's only a benefit now to basically keep the asset at the same level of performance as before, it's an expense. So that's the thinking. And then you have, here or there, a few things that are a little bit, maybe a little bit challenging, like that rearrangement and reinstallation. There you have to make sure that you at least read the textbook a little bit. So in the last 20 or so minutes that we have, we moved to a topic that is a little bit different. We're moving away from kind of our typical land, buildings, equipment, and we're going to look at natural resources. Remember, I was saying that at the beginning of the chapter in your textbook, they speak about International Paper Company that has timber, forests as part of its natural resources because it makes paper. So but those forests are there, they've been, they're there for ages. So it's not just inventory, it's actually long-term benefits are being provided. So they are being reported as property, plant, and equipment. Another type of asset that you can think of as a natural resource that's also providing, long-term benefits is a mine. Like a gold mine or a coal mine or diamond mine, whatever. Yes, you're going to sell the stuff that you are mining, but the mine itself is also treated as a natural resource, as property, plant, and equipment. So now the question is, what do we record for the acquisition of this thing? So if you picture a mine, like what are all the things that you need to do, once you have who knows, right? Do we know anything about mining? My grandfather worked in a coal mine in a copper mine for many years. So I know a little bit, but I've also been down a mine shaft and stuff, but I don't know enough because I'm not at a mining company. But of course, we have the qualification to tell us what to do. But picture the mine in your mind and see if some of this makes sense, right? If a natural resource is purchased, so this is if you buy the mine, the initial valuation is the purchase price. So if I buy the mine for $2 million, that's the acquisition cost, that's the purchase price. If it's developed, if the natural resource is developed, the following is included in its cost. Obviously, the acquisition cost, the amount that you pay to actually have the right to mine or to chop down the timber or whatever, to extract the natural resources. Okay, so how much did it cost to buy the thing? Then you can also add to that exploration costs, right? So drilling a well, excavating a mine. This is if it's an oil situation, right? Drilling a well. So notice how, based on the type of asset, what you can add to the cost of the asset changes. Here, they're saying that exploration is part of the cost of getting the asset to the condition where you can use it. So going down into the mine to see what is actually available to be sold eventually. That's still part of getting the asset to the condition where it can be used. Then they talk about development costs, right? So after you've bought the mine or discovered the mine and you've kind of excavated a little bit, you may have to, let's say it's a gold mine, you have to build a mine shaft so that people can actually go down and go and dig, or you have to build tunnels and things like that. So that's part of the development of the mine. And it could be, the equipment that you have to buy to do this. And other things that, so they talk about intangible development costs. So there may be all kinds of other expenses that you have that are intangible, whether it's you have to maybe even buy a patent or something to do a certain type of mining. So the tangible equipment costs, like a forklift or whatever, that's not going to go into the cost of the mine. That's a separate asset that will be depreciated separately. But they're saying the intangible development costs are included in what they refer to as the depletion base, is the cost of the mine that you, or the natural resource that you will be depleting, which is the same as depreciation, but it's for natural resources. In chapter 11, we'll see this again. So depletion base just means the final cost that you are arriving at, that you will be using as the cost of that asset in your books, and that you will be depreciating or depleting over time. And then another thing that is different here for natural resources compared to any of the other assets that we've looked at is this notion of restoration costs. So, if you're going and, basically destroying the earth to dig a mine and doing all kinds of stuff to get, to extract gold or whatever wealth out of this thing, often the government of the area wherever you may be mining will say, hey, once you're done, you have to restore the land, restore the property to, some previous state, to its natural state. Otherwise, and this actually happened in South Africa, where I'm from. There's a lot of mining in South Africa because there's a lot of natural resources there, and companies like Anglo American and De Beers and other companies came in and kind of just mined the place into oblivion. And then a lot of the mines that they built, the mines were just left as is. After the fact, they didn't actually restore they didn't remove the shafts and close the thing up and so on and restore it to its original state. So what happened some few years ago was that people started going down into the mines like on their own steam, which, I mean, obviously do not recommend anybody does this. They started going down and like trying to mine. I guess people were trying to get some type of income. There's a lot of unemployment in South Africa. So I guess they thought if they go down, maybe they'll find something that they can sell on. But of course, you can imagine these mines had been there for decades. The mines were completely unsafe, and people died in there because they were disturbing, whatever fragile system existed by going in and pottering around and whatever. They were causing all kinds of collapses to happen. And in the process, people actually died, which is obviously a massive tragedy. So the government had to intervene. And they should have really put this in as, I guess, as part of the requirements of even mining in the first place, telling these companies that they have to go back and restore, like close everything up and restore the land to the point that it should have been, as if the mining had, quote unquote, never happened. And so the restoration cost is part of, like, under normal circumstances, don't take the South African example because it's chaos, but under normal circumstances, before the company even starts drilling or before they even start mining or cutting down the trees or whatever, they already have to sign with the state or the government or whatever federal government that they will make these I guess we'll fix the place up when they're done. So that's also part of the cost of getting the asset to the condition, maybe not condition, but it's getting the asset to the point where it can be used. Because without signing the document, you wouldn't be able to use the assets, right? The government would prevent you from from doing it. So that's natural resources, and we have an example. The examples are a little bit, you know, they're kind of not exactly in the order of the way the materials run. So it's actually example 16 if you are using this document. That is the example where we look at which costs to include in oops, in the mine. Oh, and sorry, I forgot to say that cost that I was referring to, the cost of restoring the mine at the end of its life, is what we call an asset retirement obligation. So it's an asset, the mine. Retiring means it's no longer working, so you're taking it out of service. And obligation means that it's a liability. So you are recognizing the liability that exists because you have to fix up the land after the asset is no longer being used. Okay, so that's the language around that. So Everly Corporation, this is number 16. I'll do this with you. I'm not going to ask you to do it yourself because it's kind of the first time that we're doing anything like this. It's not as obvious as the other topics. So Everly Corporation acquires a coal mine at a cost of $400,000. So if you think about the four things that we said are included in the cost of the mine, it's the acquisition cost, it's the exploration cost, it's intangible development costs, and then it's the restoration costs. Okay, those are the four things that will go in. So basically what we're looking for in this question is to see if those four things come up. We have to include them in the cost of the mine. Anything else we will not include in the cost of the mine. So they acquire a coal mine for a cost of $400,000. So that's obviously the acquisition cost. So you can kind of put a check that has to go in because they are asking at what cost will the mine be recorded. Intangible development costs of $100,000. If you go back up to the theory that I just went over with you, intangible development costs are included in the cost of the mine. Maybe you need some type of land, like, you know, plan for how the land looks, so someone needs to draw up things or whatever so that you can actually mine. That's intangible. We're not talking again about forklifts and excavators and whatever, those are tangible development costs. These intangible ones are going in. If they had said something like a truck to move the coal from one place to the other is also, you know, costing $50,000, that would not be included, okay, in the cost of the mine. That's a separate asset. These two so far, though, are included. After extraction has occurred, Everly must restore the property. So here comes the asset retirement obligation. And and we'll see this when we do an example, which is actually the next thing we'll discuss, although we may not have time today. When we do an example for asset retirement obligations, you are recognizing something today related to an expense that you will incur sometime in the future. So let's say they have to restore the mine in 10 years' time, right? The amount that we have to put in the books today is basically what is the value today, right, of the obligation that's going to happen in 10 years' time. So it's the fair value or the present value of the obligation. And in this example, they give us the amount. In the example that we'll do after this, we will calculate the present value of the obligation. So they restore the property and it's 80,000. So that's the restoration cost. That's part of the full cost. So it would have to go into the cost of the mine, after which it can be sold for 160,000. Anybody think or wonder what that means? What is this 160,000? You think it should be added onto the cost of the mine? Since we're having a super quiet day, you can type in the chat if you want to. Right, I'm doing the most talking, right? Doing the most. If you don't want to talk, tell me in the chat. Yes or no answer. Do you think the 160,000 should be added onto the cost of the mine, since we're able to sell the mine for 160,000 at the end of its useful life?
I think yes.
So Cora says yes. Anybody else say yes or any no's? Gian, what do you say?
No.
Gian, okay. Gian, why do you say no? Do you want to tell me or you just want to say no? It's okay if you just want to say no. Another no, yeah? You're just saying no, right?
My feel, I feel, yeah.
Okay. So the answer is no, you're right. Even
Just
though, oh,
asking,
ooh, yes, go.
guess. I think it's a guess because it can be sold for $160,000, but it's estimated fair value. So
Yeah,
I don't think
yeah, it's an estimate. And also, Gian, to the point of why the answer is no, we're not going to include in the cost of buying something what we could actually sell it for in the future, right? That's like double counting. I'm asking, should you include it in the cost of what you, like, let's say I decide to buy a bicycle and it costs me $500. That's the cost of the bicycle. If I can sell the bicycle for $100 in 5 years' time, I can't say that the bicycle is now going to cost me $600, right? So what this 160,000 actually is, without making the situation too complicated, is the salvage value. And Gian is right, it is an estimate. And I'll show you here in a second how that factors into our work. So first, I'm just going to do the actual, the cost of the mine. So it's the acquisition cost, absolutely goes in. It's 400,000, right? And then it's the intangible, not tangible, but intangible development cost, right? That is going to be 100,000. And then we've got this restoration cost, right? Which is the asset, what we call the asset retirement obligation. Oh, sorry. And that's going to be 80,000. So in this example, we don't actually, going crazy here. We don't actually have any exploration costs, okay? So when you add these up, it's 580,000. That's the cost of the mine, okay? And that 160 doesn't factor into the actual cost that you pay. You're just saying sometime in the future, like Gian said, there's an estimate that we may be able to get 160,000 for it. Where it does factor in, and you may remember this like vaguely from your days of doing depreciation, is that it is called a salvage value, right? Is 160,000, okay? That is not included in the cost of the mine. However, it is used in the depletion, which is the same as depreciation, but for natural resources. It is included in the depletion, in the depletion calculation. All right. So when we calculate depletion, which will only be in chapter 11, when we calculate depletion in chapter 11, we will base it on 580,000 less 160,000. So it's going to be 420,000. That's going to be the depletion base. All right. So the cost of the mine is 580, but what you will deplete / depreciate, right, for your depletion expense every year, which we'll see in chapter 11, actually does take the salvage value into consideration. And you're right, the salvage value is an estimate. It's not necessarily correct, but Depreciation is an estimate, depletion is an estimate. They're all estimates, so it's okay to use a salvage value estimate in the calculation. If we find, and this will also come up in chapter 11, and I'm not trying to teach chapter 11, I'm just telling you how these things build on each other and why it's important to understand this now. If you find that your salvage value amount does change because the estimate was not accurate, or not correct or whatever, then you can actually change your depreciation calculations and so on and use the new salvage value. That is allowed because the FASB understands that something like depreciation or depletion is just an estimate. It's not a fact. So for our purposes of answering the question, 580,000 is the cost of the mine. The 160,000 was thrown in this case, a little bit of a red herring to make sure that you understand that it's not going to be used here. It will be used when you calculate depletion. Any questions there? All right, so I've pushed you guys pretty hard here. It's a lot of stuff that we've had to go through. So I'm gonna leave it there. Next time when we get together, so that's only gonna be on Monday. We will start talking about asset retirement obligations, and you're welcome to read through this document. It might help you to understand things a little bit better. You do have, let me see if I can actually pull this up or if I'm thrown out of McGraw-Hill now. Oh boy, okay. You do have, this will be quick. The reading for chapter 10, if you are so moved to do it in the smart book, please note again, as I said before, this reading does have points assigned to it, but it's only assigned because the system is forcing me to assign points to it. I am not weighting this reading into your grade. I know it's long, but it's, if I wanted to cover the topics that we're actually covering, it's about 90 minutes or something of reading. Some people like it, some people don't. Your choice how you want to handle it. But I think at a minimum, if you're going to be participating in the class, you should probably at least cast your eye down the summary document that I'm giving you guys on Blackboard. The chapter 10 homework is available for the people who already finished chapter 9. I don't know that you'll be able to do much, today, and you should probably be focusing on studying and beginning your review for the test and stuff that's coming up, opening, on the 19th. But if you're working ahead, the homework is available. Sorry, I didn't mean to click on it. The homework is available to you already. All right. And then just one more thing, already, but I'll say it, that our in fact, our reg hour happens right after this class. So don't forget that the reg hour information is right here. Sometimes I put it in the chat, but I mean, most people can get into Blackboard. You probably already have the information available. Rafael is there waiting to work with you on stuff to do with transfer and some visioning out of your transfer and academic and professional planning. So that's happening this week, and along with any work that you may be behind on, if you are behind. Next week, during that time slot on the 20th, I'm actually having a professional who specializes in communication, all kinds of communication, written, oral, etc., to come into the session to speak to all of us. I'll also attend the session about effective communication. It will be a very dynamic session where you guys can ask questions. She'll talk about, her experience. She is that's her job, is communications. So, think about today, like I said, you continue with your transfer planning and visioning and so on, but for next week, I'll remind you again, but think about whether you have any questions around, effective communication, emails, written, now that we're in COVID and we're doing so much more writing to each other than necessarily seeing each other face to face. What does that mean, etc. Okay, so lots coming up. I think the session with her will be helpful as you guys continue to polish, your whole persona, getting ready to really be, you know, doing whatever you're going to be doing as CPAs and so on. All right. Does anybody have any final questions or concerns on anything before? I'm trying to get this thing to open and it won't open. Before we leave here.